S minus I, S is savings. So let's just do this for the United States. S is savings by Americans. We use this as our equation for actual GDP. Everybody remember? I'd really want to remember it for December 14th if I were you. We can express actual GDP in another way. And we can do it by what do you do with the income you get from producing all of these goods and services? You either consume it, or the government taxes it away from you. And by definition, any income you have that is not consumed or not taxed away is saved. What happens to those savings? Well, that's the answer to a different question, but that's the savings. So this S is the sum total of all the savings in the American economy. And those savings then, so these we'll call these private savings, we'll call this private. And so those savings, who does the savings? The savings can be households, that's you and me. It can be non-financial firms. So when Apple makes a ton of money and it has this huge cash pile and it doesn't know what to do with it, that's savings by a non-financial firm. Or it can be savings by financial firms. Citibank has a big cash pile it hasn't invested. So one balance, the current account, one is the difference between savings and investment. Savings by Americans and investment in the American economy. And by investment in the American economy, we mean it's a little bit different than this investment. This investment in the American economy is basically investment in the real economy, the things that are here, right? The four pieces we have here, plus portfolio investment and bank lending. So we have a balance in terms of exports and imports. We have a balance in terms of savings and investment, and we know what this is, right? This is a rough proxy for the fiscal balance. Taxes and government spending.
So earlier, when you defined capital flows as the money that crosses an international border to buy an asset,
right?
The asset that you're talking about, that's I, is foreign direct investment portfolio of bank money.
That's right. That's right. So remember, before we were really strict that we're not talking about financial assets. Now we are. Okay? So this is what we're going to look at. This is the triple balance. We have a balance between exports and imports, between savings and investment, and the fiscal balance of our government. We'll see how those interact. Before we do that, we need to find the essential linking piece is the value of the dollar. And this isn't all about currency markets and how do they work and what are the different kinds of currency markets. This is kind of the chase. How do we know what the value of the dollar is? Well, to determine the value of the dollar, the great thing about the market for dollars is that it works according to classic supply and demand principles without a lot of interference. So what do? If you're going to use supply and demand, first you define the market. This is the market for foreign currency, foreigners to buy dollars, okay? So I have euros and I want to buy dollars. I have Chinese currency and I want to buy dollars. I have yen and I want to buy dollars. So that's the market. Like any market, we have a price, we have a quantity. We have supply, we have demand. So here's the supply of the dollars that are available for a foreigner to buy. Okay? So this is the supply of dollars that if I have yen, I can buy. Or if I have euros, I can buy. This is the demand for those dollars by the foreigners. So where the supply and the demand come together, here's the quantity of dollars that are being demanded, and here's the value of the dollar. Notice I call it the value of the dollar, not the price, not anything else. It's because to me it's easier to understand. The value of the dollar is determined by the supply of dollars and the demand for dollars. Where do they meet and create an equilibrium? We okay on that? Pretty simple, right? So what determines this? There are three factors to consider when thinking about what happens to the value of the dollar. We think in terms of supply, the supply of dollars in that market. And one of the biggest determinants of the supply of dollars in that market is the supply of dollars in the economy. So if you think of something like quantitative easing, made a lot of dollars, or open market operations, make a lot of dollars, that will push the supply curve out. So if I do quantitative easing, I push the supply curve out because there's more dollars. And what happens to the value of the dollar? The value of the dollar goes down because the supply went up. Now, we didn't do quantitative easing to make the dollar go down. We did it as part of the GDP story, not as part of this story, but it had that impact. So one of the things is the supply of dollars. The other thing is the demand for dollars. And without insulting anybody, the demand for dollars is a function of two primary drivers: fear and greed. Again, not to insult him, but it's fear and greed. So if something is going on in the world and you're worried and you want to make sure you stash your money someplace where it's safe, where are you going to put it? You're going to put it in the United States, aren't you? We have big markets, so I know there's always a buyer or a seller. We have rule of law. You don't lose your money. It's not like the Chinese government and suddenly you have capital controls and you can't do it. It's not like the euro where, oh my God, Greece is in trouble, and so now the value of the euro is bopping around. I don't know if I can get it back. It's not Japan where I don't know what's going on there. I don't know if it's growing, if it's not growing. So when things go wrong, when people who are investing in the $5 trillion a day market for international currency have fear, they go to the dollar. So if fear goes up, the demand for the dollar goes up, the value of the dollar goes up. So that's one way it impacts. Most important to the trade and capital flows triple balance story is greed. If I think I can make more money by investing in the American economy than in another economy, I'm going to invest in the American economy. So what are the factors that make me think I want to invest in the American economy? Well, if the American economy is growing faster than other economies, so we're growing at 3%, the Europeans are growing at 2%, and the Japanese are growing at less than 1%. Don't be fooled by today's Japanese figure. If you look at it, it's all smoke and mirrors. Or it might be too risky to invest in China. So if the U.S. is growing faster, people will want to have dollars to invest in the United States. Or if U.S. interest rates go up. If U.S. interest rates go up, that means I can buy American securities and bonds and things, and I can make more money. So if American growth goes up, or American interest rates go up, the demand for the dollar is going to go up. And again, if the demand of the dollar goes up, what happens? The value of the dollar goes up. So we okay on this and what it kind of impacts the value of the dollar? It's fear and greed on the demand side, and it's the supply of dollars in the economy on the supply side. You can do a lot of bells and whistles, but at the end of the day, that's what matters. So just before we do the triple balance, now we can finally complete the GDP story. Remember we said, say for example, we were going to do interest rates down as monetary policy. And we said, okay, that makes consumption go up, right? Because people borrow money and they spend it, and investment goes up because they see that coming up, right? Because they see the consumption. And we said, we'll do this later. We'll do it, we're doing it now. If the interest rate goes down, what happens here? The steps. If the interest rate goes down, what happens to the value of the dollar?
Goes down.
Why does it go down?
People can't make money.
That's right, because I can make money someplace else. My greed factor says I'm invested in Germany, not in the United States. So the value of the dollar goes down. If the value of the dollar goes down, what happens to U.S. exports? They go up. Why?
Cheaper.
Because they're cheaper in foreign currency. What happens to imports? They go down because they're more expensive. So what happens to this term? It goes up. So it's consistent with the other pieces. Okay, does that make sense now? So if you're answering a question like this on the final exam, you can fill in the third term now. Okay, through the value of the dollar. So now we're all set. Now we're all set to do the triple balance. Okay? The starting point, the triple balance, is the balance of payments. What's the balance of payments for Paraguay? Quick, what's the balance of payments? Zero. What's the balance of payments for the United States?
Zero.
Balance of payments for any place is zero. That's what you mean by balance of payments. The balance of payments is the record of international transactions of goods and services and of money. Okay, of X minus M and of capital flows. In the United States, it has three parts. It has the current account, which is what we're going to call X minus M. And the current account has four pieces. It has the balance of trade in goods. It has the balance of trade in services. Makes sense, right? How many airplanes do we export? How many versus how many cars do we import? You know, kind of the insurance and consulting services we send in, the tourism stuff we do abroad. So it's goods and services. It also has two other components to it. It has investment income, the balance of investment income. What does that mean? That means in the past, Americans have invested abroad and foreigners have invested in the United States. So in the past, an American has bought stocks and gets dividends on those stocks. That's investment income coming in. The Chinese have bought American government debt and we pay them their 2%. That's investment income going out. So that's the income on investments that have already been made. Everybody clear on that? And the final one is net transfers. Foreign aid, remittances, money you just send across the border, not to buy something, but just for the sake of sending it across the border. Again, the two biggest ones are remittances. Everybody know what remittances are? Mm-hmm. Foreign worker works in the United States and sends money home. Or foreign aid, you know, kind of sending money to the whatever the size of our foreign aid. So this is the current account. Then we have something called the capital account. And we're going to totally ignore that because it's essentially zero and it's not relevant. It doesn't impact the numbers. The other really big one is the financial account. The financial account is investment. It's foreign capital. It's investment. It's the Americans buying assets overseas versus foreigners buying assets in the United States. So this is goods and services, and this is money. Way to think about it. You think of goods and services plus money equals zero. What does that mean? That means that if you're the United States and your current account balance is minus 2.6% of GDP, so we, the United States, we're buying more from foreigners than foreigners are buying from us. How do we pay for that delta? They don't just give it to us. We sell them assets. Borrowing is selling an asset. Borrowing is selling a debt security. Or we might sell them the Waldorf Astoria Hotel. Or they might buy a firm. Any of these. Foreigners might buy firms, they might buy stocks and bonds, or they might work through the bank lending to buy things. But we make up the delta. We buy more from abroad than we sell abroad. We pay for the difference by selling assets. That's what this says. So if this is minus 2.6% of GDP,